Hey, how you doing? And welcome back to another episode of The Rules of Investing, a podcast that gets inside the minds of leading investors, economists and industry experts, brought to you by Livewire Markets. I'm Ali Selby, and in the last episode, you learnt how some of Australia's ultra-wealthy invest with the help of capital raiser Louise Walsh from Walsh Capital and the CIO of a family office, Peter McGee from MRB House. This week's guest is on a mission to truly surprise our listeners. He believes investors are underappreciating the real impact of artificial intelligence on markets and how we value stocks. In fact, he believes it's the end of the world as we know it. This guest is none other than fan favourite Rudi Filapek-Vandyck from FNArena. Let's get into the rest of the podcast later, but first some housekeeping. If you're an Apple Podcast or Spotify user, don't forget to subscribe to the podcast so you never miss an episode. Or if you're a Livewire subscriber, hit the follow button at the bottom of the wire to be notified when new episodes are available. Not a Livewire subscriber yet? Just head on over to livewiremarkets.com. It's free, easy to register, and you'll get access to insights from leading investment minds in the country. Okay, let's get on with the show. Thank you so much for joining us today, Rudi. I'm really excited for this chat today.
I think we should be playing some R.E.M. music in the background now.
A little bit of electronic music, have a little dance off. It is quite dark and moody in here. As I mentioned in the intro, you told me you were going to surprise investors, and I do hate to admit this, but I feel like a little bit of a skeptic just because last time you told me I was going to leave a changed woman, and I wasn't. So my question for you today, what do you think the market is getting wrong, and what will be something that will truly shatter investors' worldviews?
Well, I'm not so sure what I'm going to shatter them, but there's a lot of changes taking place, and I think the saying in investment markets is always the four most dangerous words being uttered by investors is "this time is different." But I personally think that's the most that's the tool and the saying that's most misused and used in the wrong context in and around investment markets. I mean, let's if you sit back and look at what happens throughout history and in daily life, I mean, things change all the time. I mean, it's just that most changes take a gradual pace, and we're sort of like the boiling frog. We almost not realizing that things are changing. But there are times in history, and one of these times is right now, when those changes go into acceleration. And why is that? Is because we go through these periods when there's a lot of change happening on the back of technological innovations and new inventions, basically. And we have a few periods in history where my favorite one to compare with is the 1920s, which essentially is 100 years ago. And 100 years ago, if you exactly deduct 100 years from today, we would be now in a new, fresh bull market that would last until late 2029. And then, of course, came crashing down. I mean, but if you go through those periods and you learn from history, do you realize that things already have been changing? And there's a fair argument to be made, and I've made those arguments already in the past few years, that the share market itself has changed since 2014. That's already 10 years ago. And
why do you think that?
It's not just thinking, it's also observing. I mean, for everyone who has his eye in the right spots, they would have noticed, for example, that the share market in general is trading on higher multiples than it was before. I mean, traditionally, the share market in Australia would be valued on average at 14.5 times next year's profits. That has crept up to 14, 15, and in these days it's actually closer to 16, and that's the average of the last 10 years. Result number one is that there's so much talk about it's a bubble, it's going to come crashing down, it's too high, investor sentiment is elevated, all of that. I think that's misplaced, because you're basically, all those people who are saying that have not caught up on the fact that the average multiple is higher. So while I'm not saying that the share market today is not trading on elevated multiples, and it probably is a little bit too high, what I am saying is that the degree to which there is a little bit more exuberance in share prices is not as high as you would think from historical perspectives. So now you have to reason in higher multiples. And why is that? Two reasons. One is that we get a different type of company, and that comes in the slipstream of those technological times that we are going through. We literally have a different type of company that's coming to the share market. I mean, and those companies, they are increasingly becoming more important for the index and for the market in general. Think WiseTech, Block, but also some of the old stalwarts still. I mean, we have CSL, we have ResMed, we have Cochlear, they're still in there, and Macquarie Group and stuff. What investors also should catch up on is that those companies are valued on a different manner than your typical bank, resources producer, or your oil and gas company. That's something that investors have to get their head around as well. I mean, the market has become a lot more sophisticated, and that's also an observation. I mean, if you have tried to buy something like, let's say, a Technology One or an REA group or a car group, if you have tried to buy them at low PE multiples, well, you never bought them. Maybe with the exception of 2020 when we get a big sell-off. So that should make you think, and I think that's already lesson number one. Investors have to get their head around in how those companies these days are being valued. I mean, they're not in the traditional manner of low PE, high PE, etc. What is equally important is that technological era has started in 2014. We've already seen those changes, and there's an argument to be made that after 10 years you could say, well, maybe that's a bit long in the tooth, because we've now had one of the results of that is that we've seen growth and quality sharply outperforming the value part of the market. I mean, and a lot of value investors, typical value investor, will tell us it's not going to last. Reversion to the mean, we're all very keen on it. The problem with that is that after 10 years, we now get GLP-1s and we get AI. And I would argue that's a strong argument to be made that you shouldn't count on reversion to the mean here. I think this is a strong extension of what already has been in place since 2014. And it's going to probably define life as we know it, with consequences for investing in share markets for the next 10 years. Now, it's not going to go in a straight line. Yes, bond yields, economic growth, it all will impact. But in general terms, this, I think, should be on investors' radar, because the growth that comes towards those companies is absolutely mind-blowing. And what I pick up in recent times is that investors who go to the US, analysts that go to the US, and they try to get their head around what actually is happening there, without exception, they all return to Australia, and they all have this idea that there's literally a tsunami in investments is happening in the US, and it will trickle down into the Australian share market. Now, we're talking a process here. If this is going to last 10 years, and it will outperform the importance of mobile phones and of the internet, if current projections are correct, then this will still not go in a straight line and will not impact on all companies equally. In the first phase, and that's where we're in now, we will have the so-called pick and shovel providers, proverbially. I mean, so the guys who got rich in every gold boom in the past were the guys who sold the pick and shovels to the gold miners, not the gold miners itself. What do we see now? And that's just like on the internet. It was the infrastructure builders that initially benefited from the internet, not the ones who came up with the first browser. What we see now is that the proverbial pick and shovel providers, which essentially now is the chip manufacturers and the data centers. And you see that in the share market at the likes of NextDC, Goodman Group, they are now seeing this enormous demand coming towards them. And here's the challenge for investors, because we now have caught up that these guys see unprecedented investments coming their way. And of course, those share prices go up and they're trading on high PEs now. Now, here's the challenge to get your head around. What looks expensive in the short term, you go 3 to 5 years into the future, you look back, it's a bargain. All right? On some calculations, the share price of a NextDC, for example, might well go to $40 in 3 to 5 years' time. Let's say it doesn't get there. Let's say it stops at 30. The share price now is $16, $17. The challenge for investors is, are you going to be deterred at $16 because the share price looks expensive right now, or are you going to stay the course or get on board, and in 3 to 5 years' time you look back and you made 100% return? And I think that's something that investors at this point in time will have to get their head around. It won't go in a straight line, but in a macro concept, that is the challenge that now lies ahead.
What does that mean for value investors? And are you calling, I guess, the death of value as a factor, or the death of value fund managers, I guess, as well?
Well, one observation is that they are going through a tough time. Platinum and others, I mean, they're not the best performing fund managers out there. And in general terms, I don't think your pure value investing will ever go out of fashion, because the share market being the share market, it will always push up share prices too high on one end and always push the share prices too low on the other end.
And then also some of the world's most famous investors are value investors.
Yes, but maybe not in the same sense as value is something that is interpreted in many different ways by investors. And when things are different, then you have to almost reel out the lessons from Charles Darwin. And it's not the strongest or the one who has the most money, but you have to adapt. I mean, and I think unless you're your typical value investor, and as I said, you're essentially investing in the mispricing of assets, essentially, and you probably don't care anything what happens to the future, that's fine. But I have a suspicion that the arrival of AI is going to polarize the market even more than it has been over the past 10 years. And I think every veteran in the share market will acknowledge that the past 10 years has seen polarization in the market going to extremes and probably never to be seen. I have a suspicion that might actually become much, much wider. And that's the danger then for investors thinking that there's value up for grabs, and they're actually going into a trap. And why is that? Is that the two things I know now about AI at this stage is, one thing is it would appear, because investing in AI requires a lot of capital. That's already is certain. So it would appear that there's a danger that at some stage governments will have to intervene, because there's a danger that the true access of AI will become very concentrated in a few mega companies, and all the other ones are playing not even second fiddle but third fiddle, and that's a danger for the world. But apart from that, while we're now talking about data centers and chip manufacturers, that whole process will ultimately, just like the internet, that whole process will ultimately unfold and develop further. And we will go to much larger impact economic-wise and for other companies. What that means is that companies will be forced to make investments. And for a quality investor like I am, I've long acknowledged that the difference between a high quality and a low quality company is basically the ability to make consistent investments and to get a return out of those investments. So if investors want to know the secret sauce, what makes companies like a Technology One or an Aristocrat Leisure, or even today a Webjet, what makes them so special, or what puts them in the position where they are, you can relate that back to investments that have been made in the past. If AI really becomes as important as we now think it might be, then it will divide the share market between companies who can successfully make investments and make AI their second nature, and those who can't do it. And that's why I'm thinking that those who can't do it will ultimately end up as value traps, and any value that as an investor that you will get from them will be short term only. I mean, if I can throw in some hyperbole in this conversation, is like, if you go back 100 years and you just realize that in the US the trains went bankrupt because they were all corrupt, but then the manufacturers of carriages that were carried by horses and by oxes. They're now being threatened by someone who invented the automobile. Now, what happens in the share market is that the automobile, from the moment we see as a collective, we see the value there and the prospect, we will place all those automobile manufacturers on a high PE, and we really value them. The manufacturers of the carriages will trade on a low PE, and they might, on some case, bond yields, economic growth, momentum changes in the share market. They might have a big upswing in their share price, but ultimately they go out of business. And that's the challenge that investors will have over the next decade. If AI will have that influence that we now think it might have, it will really divide the share market, and it will polarize to probably to extreme levels. I mean, the other thing to consider, of course, us humans being humans, we always do the same thing. I mean, it is well possible that within years to come, we will have an extreme valuation for some of those AI beneficiaries. And yes, it might end in a bubble and a big sell-off, and because that's what happened after the 1920s, and that's what happened after the 1990s. But you have to question whether you should be worried about that right now, because it might still go on for 7, 8, 9, 10 years. Yeah? And if you look back then, you go like, right?
Was it worth not owning them?
Was it worth not owning them? Was it worth being worried about that one in 2024? And I'm almost inclined to think that you're way, way, way too early with that. And I think that the challenge is to make money out of the history that is about to repeat, and that will change society as we know it.
Before you talked about the stages of, I guess, AI winners.
Yes.
And in the first stage being the picks and shovels plays.
Yeah.
What are the next stages?
I think the next stage will be to the people who sell it. And I think in Australia we will move to, for example, to Officeworks at Wesfarmers. We will go to Dicker Data. We will go to Data 3. Companies like that. It might actually also include the likes of JB Hi-Fi and Harvey Norman, who sell it to consumers and to small businesses as well.
Is it worth investing in those businesses, or should investors look offshore to the global leaders like Google and Microsoft? Why invest in those Aussie players when there are these incredible companies on the global stage?
Yeah, well, that's a choice, of course, and my analysis over the past decade or so is that investors can have US similar returns in Australia as long as you have similar stocks in your portfolio. And what that means in practice is that if you had investors in Australia and instead of owning the banks, Telstra and some of the resources stocks, if you had owned REA Group, Block, WiseTech Global, Altium, Car Group, ResMed, CSL, and a whole bunch of others, Technology One. If you had owned those shares, you would not be jealous today at the returns that were made in the US, and that is a fact. Yeah, and there is your challenge. Are the beneficiaries in the US, are they cheap today? No, they're not. I mean, are the beneficiaries in Australia, are they cheap today? No, they're not. But there will be more beneficiaries down the track, and it will morph, it will change. And the challenge is to get the right context around things happening, to get the right perspective. And again, as I said, is a stock that is going to double over the next 5 years, and it looks expensive today. Does that mean it's uninvestable?
If sellers are the next stage, what's the stage after that?
Well, the thing is, the problem with these predictions always is that they almost by definition change from the moment you make them. And while we don't know exactly how technological advances, and that also includes GLP-1s, by the way, while we don't know, and cybersecurity and some of the others, we don't know exactly how the trajectory will unfold. But what we, with a very high reliability, can make is that this will not go away. This will change the world, and we will look back in 10 years' time, and we will look back to today, and we go like, ooh, this is a bit different. Just like when all of a sudden we had smart mobile phones. I mean, and it did change the world. I mean, it ruined a few industries. I mean, like who has a camera these days?
That's very true. There's obviously quite a lot of AI skeptics out there. You talked about the polarization before in the market. Is there anything that they say that makes you go, maybe I'm wrong on AI? Or
no,
nothing at all? You're completely convinced?
No, while I admit that making very strong forecasts 5, 7, 10 years into the future always has a lot of danger with it. And as I said earlier, we don't know the exact trajectory of how this will unfold. But at this point in time, it is without any question that the demand that is coming through in Australia for the data centers, Goodman Group, NextDC, and some of the other ones, that is tangible and real. The pipeline is tangible and real, which is why people project forward and make forecasts like $40 for NextDC. And it's not just because they put their finger in the air. The other lesson I've learned, and I think this is very important as well, if I wonder whether I need a haircut, I'm not going to ask my dentist, and I'm not going to ask the one who does my hair what he thinks about my teeth. Yeah? One thing I've learned about the share market is that you should never ask a value investor, your typical value investor, whether he should invest in growth. I mean, you should ask the right people. And at this point in time, I'm willing to bet my money on fund managers at Hyperion, for example, at Alex Pollack at Loftus Peak. And I'm more willing to lean towards those guys than I am to your typical platinum who will tell everyone that the market is getting crazy again and PE ratios are too high. You just have to understand, like, I mean, we have the Euro football about in a few weeks' time in Europe. I'm not going to ask any Australian who loves AFL, NRL or rugby union what he thinks and who's going to win that tournament. Huh? But if you're English, you might actually have a conversation with me because I know you know football. Right? It's the same in the share market. I mean, there are different religions in the share market. I'm in between value and growth. I'm very concentrated on quality, but I've come to appreciate over the years, and particularly over the past 10 years, that my quality focus leans more towards growth than it does to value. I mean, a lot of the value propositions, I just think they're, right? Like, if you're an investor in Lend-Lease, for example, are you happy now because they're finally taking action? Well, maybe, but you've suffered. Hopefully not, but most likely you've been suffering now for years, and you get your happy moment after years of erosion of your capital. Basically, that's not my type of investing. Right?
How do investors actually value these AI stocks then? What are your recommendations actually? Looking at the fundamentals of these companies.
There are a few elements to this. Yes. Too many people, I think, are still relying on books that were written in the 50s, 60s, 70s, even in the 80s, and how to value stocks. Yeah. Like, I mean, I run a service as FNArena. I'm assuming that a lot of people will know the service, and that gives me an insight in all the things that are changing. I mean, and while decades ago you could poke a lot of fun at how analysts at Wall Street were doing stuff. Today, I can guarantee you they're a lot more sophisticated and a lot more knowledgeable and up to date in how they value stocks. It has become a lot more sophisticated. Now, whether you have to go into the detail for that, I mean, there was a professor in the US, Aswat Damodaran, and I hope I'm pronouncing his name correct because it's quite exotic. I mean, he shares via YouTube, via his website, via his. I mean, he will. I mean, I've read his book as well. I mean, it's very technical, but it gives you lots of insights in how today's companies' businesses are being valued. In general terms, if you are reliable and you are of more quality and you give more security to investors, you basically get a higher valuation. That's the long and the short of it. Broader terms, though. Without going it, if you just look at in broader terms, I rather put my money in something that is about to explode in the years ahead than trying to pick something that is cheaply priced for the moment. And I think that's to recognize that. I think that's much more important for investors than trying to pinpoint exactly at what percentage point behind the decimal point is the valuation of a certain stock.
You've talked about quality quite a lot today.
Yes.
Why do you think quality investing is so important right now?
It has been important already in the past 10 years. I mean, quality doesn't necessarily always outperform, but it does perform. One of my favorite stocks has just reported, Technology One. Right? It basically doubles every 5 years. Now, I know people out there, they don't like the company, and there's a few of them, and they think it's always too expensive. But the problem is, if it doubles every 5 years, that is a quality that you don't find in too many segments of the share market. What I can do with a stock like Technology One is I can literally treat it as in my bottom drawer and just keep it there. And unless the world really is going to change a lot, and including for this company, I'm quite confident that in 5 years' time, the share price will be double, because the company will be double. Yeah. In the meantime, yes, we get interest rates, and we get other considerations, and momentum plays, and etc. etc. But where it comes down to me, like when the share price weakens, I always draw a lot of confidence from the fact that A, I know the company, and B, I can trust in it because it's a quality company. If I were in a lower quality company and the share price would tank, I would have a lot less confidence in it. And I think history, past 10 years, past 15 years, past 20 years, have proven me correct in that those are the type of companies that you can trust.
How do you define quality? I feel like
yes.
For every investor out there, there's a different definition of quality.
That is true.
What does it actually mean to you?
That is true, because just like there's so many definitions of value out there, there's not one definition of quality out there. I think for quality, there's two elements to it in my world. One is that it defines companies that can perform under most circumstances. And that's why I call my research into all-weather performers, because it doesn't matter whether it freezes, rains, the sun shines, the wind blows, those companies can perform. I mean, and that's definitely not given to all companies. But equally important in my definition of quality is that if you drill down into the finer details, it comes basically down to companies investing. Yeah? And why is that important? I mean, obvious observation. Yeah? 3 of the 4 major banks in Australia, and it becomes 5 out of 6 if you add the 2 regionals to it, those share prices have not moved in 15 years. Yeah? The only exception is Commonwealth Bank. What has Commonwealth Bank done differently from the others? It has taken investments on board 10 years ago that the other ones are taken on board right now. Westpac, for example. Yeah? See, that is the difference. And once you recognize the importance of making those investments ahead of the pack and making them consistently, that means that you can attach a value or a quality label to that company. And almost by definition, if those investments are being made on a consistent basis, you can be quite reliably predict that even if they run into headwinds at some stage, they will come on top of it.
What do you mean by investments? Because there have been, there's obviously some bad investments as well. Not all investments can be good.
Telstra makes investments and there's no return on them. And that's obviously that's where the secret sauce comes from. You have to invest in new products, in new services, in making your business better, in making your moat stronger, in keeping your number one position that you have, and that requires constant investing. And if companies do that in a good way, then you get a great company. Like if you ask me why is Aristocrat doing so well, ask them. It's consistently making investments, in new products, in their services. Why is Webjet today outperforming the rest of the sector? They made investments when everyone was on their knees. Why am I still confident that a share price in CSL will come on top of it? Because they're still investing $800 million a year. They're not going to spend $1 billion every single time on a product that won't deliver. they will come good because they make consistent investments, and that's basically the secret sauce. Right? It also shows you in the share market that why investors have to be cognizant of about how life is changing. Yeah? Because what do most of them have in their portfolio? It's banks, it's Telstra, and it's a few of the other guys. If you know that 3 of the 4 banks haven't moved in 15 years, and the share market over that period has done something like 8-9% on average a year, is now at all-time highs, then you know it's coming from other segments. Yeah? And why wouldn't you have those in your portfolio? Because you've basically done yourself a disfavor by sticking with the wrong side of the ledger.
Where are you seeing businesses that are investing heavily ahead of the pack today?
Yes.
What businesses have you been adding to the portfolio recently because of that reason?
Yeah, well, I've already mentioned a few. I mean, I'm a long time and at this point in time quite comfortable investor in the likes of Goodman Group, NextDC, in R.E.M Group, in still in CSL, ResMed, Technology One, Aristocrat, Car Group. Don't forget Car Group, often underestimated. You can't own them all. I would also think that the likes of Seek will come good.
Why can't you own them all?
Well, there's two definitions in how you would construct a portfolio. You either own them all, and then they all represent like 1 or 2% in your portfolio, and that's, I mean, some investors do that. Or you sort of concentrate your portfolio to, like in my case, I concentrate, let's say, around 20 holdings. That's about average between 3 and 6%. Well, that means you can't own them all, and I'm more on the little bit more concentrated part, and then it means that even stocks I sometimes like a lot, I don't own them for the moment, right? And that's just how portfolio works, basically.
What's your biggest position right now?
That's CSL still,
right?
But it would not be that far off from Goodman Group and an Aristocrat Leisure.
Okay. Have you sold any stocks recently? Is there anything that you're feeling like, I don't know, just the story has changed?
Yes.
You're not feeling so confident about that quality company anymore? I just did an episode of Buy, Hold, Sell, and we talked about companies that are quality companies that are almost masquerading as quality companies.
Yes.
Have you found that yourself?
Yes, you do have pretenders, and that's because sometimes the story looks better from the onset than it does in practice. I don't think I've had too many disappointments in my all-weather segment, but I do see in my portfolio construction. I always have a percentage in gold as well. And I have a segment that I dedicate to dividends, to income. That's the weak point in my portfolio, I find. I mean, and why is that? Is because if you analyze the share market, you realize that to get a dividend stock doesn't just require a company paying dividends. It requires a relatively cheap valuation, which basically means those companies are not the strongest. Yeah? In practice, I noticed over the years, that's where most of the disappointment comes from. I mean, because strong companies trade on higher multiples, they will still pay you dividends, but the yield will be not that high, so they don't qualify as a dividend stock.
What stock do you invest in for that?
Yes, so I have from memory, I bought Dicker Data when they were pretty much on their knees. They were a very high yield, and I was very happy to snap them up. I've kept them because, as I just mentioned, I think they might be one in the next phase of the beneficiaries of the AI. I have the Homeco Daily Needs read in there, and that has performed quite well. And I'm still thinking if bond yields at some stage will come down, that share price will re-rate higher. The disappointment in my portfolio there is that I at one stage when Telstra was very low, I added Telstra. I did really, really well out of it because they were going to sell assets. And of course now we have the opposite side. Now there's doubt about the dividend growth of the next year's ahead. So I've been umming and ahhing about Telstra for quite a while, to be honest. My lesson, and I've been telling that to FNArena subscribers who ask me questions as well, never have high expectations about a subpar quality company. I mean, the reason that I benefited a lot from Telstra at some point was luck. I was just lucky. And I should have very moderate expectations now, because you know why? Because Telstra is not a high quality company. It's a moderately quality company, and it's basically, I mean, it's not going to do much. Just like 3 of the 4 banks haven't done much over the past 15 years. So I'm actively considering switching Telstra for something else, but I haven't made up my mind yet.
It's interesting you mentioned Telstra, because I recently went to a fund manager shareholder day. I won't say which fund manager it was, but they were saying that Telstra is going to be an AI beneficiary. Yeah. Do you disagree with that?
No, but that's the problem also when you invest in those themes, is that they might benefit on one end, but they also could well have the negative impacts on the other end of the business, and that's the problem with those. And I've come across those predictions as well. And I always think like, I rather have a beneficiary that is undoubtedly a beneficiary than one that is a little bit of wishy-washy and one end might actually. Listen, telecommunication industry, you can also tell it from other companies in that industry, it's not going well. I mean, it's not fantastic. It by no means matches anything that's happening in a lot of other sectors. It's commoditized. It's not going very much. Telstra is struggling because it's a beast that has so many arms and legs, and there's always an arm and a leg that's in a twist somewhere, and that's just the fact of life. I mean, and again, my conclusion: I rather overpay for a company that is in splendid form and has a great future ahead of itself, then I snap up a low quality stock that seems to be offering quality or value or upside in the short term. I like my portfolio to be forever. Yeah, and when people ask me like, how long do you think you're going to own this stock? Well, I snapped up Dicker Data when it was cheaper. I'm still trying to probably keep it for the next 5 years or so, because I think it will do better. I mean, I'm not the type of investor that switches all the time. I mean, and here's also a very interesting concept about that is, there was research out there that if you look at professional investors, institutions, the better performing ones are the ones that churn very little. Yeah. So they have their stocks and they keep it. Just what I do, man. And yes, sometimes you have to take it on the chin. That I own Woolworths. And to answer your previous question, I've added to Woolworths after the sell down, because I think Woolworths is one of those companies as well that temporarily is out of favor, but it's a strong franchise, and they will renew their franchise, and they will invest in their business, and they will come over the top in greater shape.
There was a little bit of Warren Buffett in that, the best holding time for a stock is forever.
Yes, and I've myself found that if you have quality companies, you can have that principle. Right? Like a temporary headwind is just that, a temporary headwind.
I want to talk about cash now. Yeah. So I feel like every time we talk to you, you've got so much bloody cash. It's always like 19%, 18%. Yeah. What's your cash looking like now?
It's a lot less, I can tell you. Yeah, I'm not sure exactly what it is, but it's no longer there. I've put it to use, and I've put it into companies like Woolworths, also in from memory in Goodman Group, in Hub 24, and probably in a few other companies as well. So I've definitely put it to use.
I recently had dinner with some family friends, and one of them is honestly your biggest fan. It was so nice. He follows your all-weather portfolio. Hi, Greg. Very exciting. I'm going to ask a question from Greg. Okay. He wants to know whether he could ever see, or you'd see, ETFs like FANG, Drug or Hack becoming part of that all-weather portfolio mix.
Probably not, because you have to be... See, the whole characteristic of all weathers is that that they perform regardless of what what in the moment is the theme or the thematic that is the main. And I think that's the danger, that's the mistake that a lot of people make. I do get... Hi, Greg, by the way. I don't know him, I don't think, but I appreciate the question and the appreciation. I mean, I'm obviously going to leave today with a big smile on my face. But I think when I do get questions on a regular basis, like is Infratil, should that be in there, and should some of the other stocks that at the moment are performing well, why aren't they in the all weathers? Well, the whole thing about all weathers is that they don't perform just 1, 2, 3, 4, 5 years. They perform 10, 20 years, yeah, and that's the whole characteristic. So you have to pick things that withstand the pressure in the moment or the headwind in the moment. And I mean, I wouldn't even. For example, I just noticed that Goldman Sachs still has Nvidia on their conviction list. Right? Personally, I would not put Nvidia in my list of all weathers. Why is that? It's because they have this tremendous growth coming towards them now, but logically, at some stage, they will find it very, very hard to keep that going. Yeah? And there will come a time when that whole AI story will have an interruption, or something going sideways or whatever, or temporarily a pause. And that's the whole characteristic, yeah, that as a company that you can withstand that. I'm not so sure whether a chip manufacturer can withstand that. So the answer would be no, basically. Although I would be the first one to encourage investors to invest in megatrends. And the ones that you just mentioned, like the cybersecurity and all that, I mean, those are megatrends. Yeah? So while I wouldn't regard them as all-weather performers, I think you can keep them in your portfolio for quite a while. And you are definitely riding the right trends there. I mean, if you have to choose between the carriage with the ox or the motorcycle in its early existence, you will always go for the motorcycle, yeah? Well, if you're my type of investor.
He was also talking very excitedly at dinner about some of the awesome kind of penny stocks that you've recommended and how much money he's made from these. It was just really lovely to see someone so passionate about investing and such a big fan of yours. I was wondering, I feel like we always talk about quality large caps, you and I.
Yes, majority, yes.
None of these small cap stocks. I'm like, where is Greg hearing all this stuff?
I do sometimes pay attention to small caps.
I would love a micro cap or a small cap stock that you are super excited about right now, and explain to us why.
Yeah, I'm not so sure about the super excited, but first of all, and that's also if you look for high quality companies, yeah, they have to deserve that label. And if they're small caps, they haven't. They don't have enough track record. They don't have enough. And there's also a lot of disadvantage of being a small cap anyway, as a lot of investors have noticed over the past 2 years. Yeah? Like when the first ones going out the window when bond yields go up is small caps. Wait until we get a scare about a recession. Yeah? Small caps will go out the window. But having said so, I do pay attention. Also because what I tend to do often is when I see a smaller cap stock that might be interesting, I tend to follow it, and I give it about like 3-4 years, and then that's often a period that the true colors will come to the fore. And that's also when sometimes when you go like, oh, I'm so happy I didn't go there, or sometimes that's the other thing. Yeah, if they prove themselves over that period, and that means they are on a great path. There's still time to get on board, right? To give you one example, I bought at the time Zero at $27. I saw it going to 127, I believe. I mean, I could have bought it at 45. Yeah, like I didn't buy it at $2 or $3. You don't have to. There's plenty of time. Now, coming back to your question, I recently came across a relatively real. I would describe it as a micro cap.
Okay.
And
how big is the market cap of this stock?
27 million.
Okay, tiny.
Yes, exactly. And I actually learned how to pronounce its name. Imagine. So it's DMEM.
Okay, and what do they do?
They do essentially wastewater and water cleaning, and they have a very unique business model, very ambitious. CEO is very ambitious. And they seem to be getting their strategy seems to be executing on the strategy. There are regularly acquisitions taking place with capital raisings, which means investors have all the time to get on board. It's a micro cap, Microcaps at the moment are not very much in favor, but it's on my radar, and it does by no mean that I will buy the stock tomorrow or so. But if they make the progression that they are making now, and the general sentiment in the market improves, because that has to happen before you go to microcaps, then this share price could go a long way, I think.
Okay, we've come to the end of the podcast, so we ask our guests the same questions. They're always a little bit of fun.
Mm-hmm.
What's a story of a big loss or a big win from your time investing, and what did you learn from that?
Well, I'm not so sure. I have. I mean, the example I usually use, and I don't actually remember whether I've mentioned this in the past, but once upon a time, I was a shareholder in Slater Gordon, and you won't believe it. It was for a while actually the best. I remember it was the best performing stock in my portfolio.
Wow.
And I was actually really chuffed with myself. I go like, look at me. I mean, and then of course the acquisition happened in the UK, and the whole thing came unraveled essentially. And the lesson that I've always learned from that is that it is never too late to sell. And because before you know it, all those gains you've made, they disappear for the sun. You take a breath later, and now you're sitting in the red. And the losses only accumulate, and most investors will have that response like, well, no, I'm not selling now. I'm going to wait until I get my money back, or whatever. And the problem with that is, long story short, ultimately the share price lost 96% of its value, and I'm so happy that I wasn't there when there's only 4% left, because mathematics will tell you, you're never going to make your money back now. Now you've done yourself a really big disservice. And that's why I always say to people, mistakes, we all make them. And sometimes maybe you don't even make a mistake. I mean, maybe sometimes things change. Company changes, world changes, the market changes, whatever. You should never be afraid to just go, listen, okay, this is not working. Right? Just sell, move on. Right? And
do you have like a percentage, a stop loss, where you're like...
No.
10%, I have to, nothing like that.
No, I don't, because that would have, for example, forced me out of ResMed, and I stuck the course there, and I'm very happy I did. So sometimes, I think it's more important, and I know it's easier said than done, but the more I do this, the more I realize, know your stocks, know your companies, and know why you own them. And if the world goes crazy, and all of a sudden start selling off ResMed because they don't know what's happening, and the shorters move in, etc., then it's good to dig in your heels and to be convinced that your thesis is still correct and it's not being disrupted. It's only a matter of time, and that's the disadvantage sometimes when you have those strict rules. Having said so, I'm also shareholder in IDP Education. And maybe I should have sold there in an earlier stage. But I do think that story is gradually turning around now. And that was also, I think the good thing there is that at the very least I acknowledged that the uncertainty was there, and I didn't add to my holdings. I actually, at one stage, I halved them, and I kept them at that level. And that also gives you an idea that sometimes you just have to make those gut feel decisions by not just throwing money after throwing money, and the share price just keeps going in the same direction, the wrong one.
That was definitely the biggest mistake I've ever made, is throwing more money at something that's
too easily done.
Southward.
Too easily done. I mean, I at one stage had a investor contacting me, and he basically turned, by doing that, he turned $400,000 and $50,000.
That makes me feel sick.
And exactly. And your stomach really turns. And I literally told them, listen, rule number one, you're never going to make your money back. Just forget about it. It's not going to happen. Yeah. And that's what the mathematics will tell you. Yeah. A stock that goes down by that much, it has to go up. It has to all of a sudden go up by thousands % or whatever. But yes. And that's the danger of just going like, I'm averaging down. You go like, yeah, no. Like I almost never average down. Yeah? It doesn't mean that I don't add extra money when the share price goes down, But like I bought extra Woolworths shares. Yeah. That's not averaging down. I'm just maximizing the fact that the share price gets weak at a certain point, and I just make an investment in a cheap looking share price. Yeah. But I'm not doing it to get my average down. Yeah? I'm not interested in that. And the averaging down, that's meant for a trader, maybe. But if you want to go bankrupt, just think of all the people who average down in AMP, in Lend-Lease, etc., etc. It's simply not a great strategy.
Okay, last question for today, and probably my favourite question as well. If the market was to close for the next 5 years, which one stock and one stock alone would you want to own and why?
Well, I'm going to break the rules because rules need to be broken every once in a while. To put my conviction to the conversation we had today, I'd be very happy to own both Goodman Group and NextDC for the next 5 years, because I'm convinced with the growth that comes towards those companies that the share price will be a lot higher in 5 years' time. And in the meantime, I don't have to worry what happens to the share price. I mean, all the fluctuations, all the volatility. But if we exclude the AI story here, then my nomination would be CSL. And I think that's one thing I've learned as well. People have strange ways of looking at shares. And because the share price has moved in now 2 or 3 years, everyone's now convinced that the stock is dead. Nothing's going to happen there. You know? And I think you should turn that around. Because it hasn't happened in the past 3 or 4 years, this is now why you should consider owning that stock. Yeah? It's the other way around. Yeah? In 2020, when everyone was moving into the stock out of fear out of what COVID might do, that was the time to question the outlook for CSL. Yeah, not today when they've had all the bad news thrown at them and they are working now on improving their margins. Yeah, now is the time to own them. So for the next 5 years, I'd be more than happy to have CSL in there. And after 5 years, I look at the share price and I go like, my goodness, what a nice surprise is this?
Oh, fingers crossed. I hope so. I own CSL as well. It's definitely been kind of an annoying position in the portfolio.
Yeah.
But yeah, fingers crossed. Well, thank you so much for your time today, Rudi. I absolutely loved this chat. It was so fun. Thank you for coming on the Rules of Investing.
I hope the viewers and the listeners appreciate it as well.